Thank you.
First of all, I would like to thank the University of Lausanne for this conference, and I have the pleasure to be the chair of this panel. We try to introduce a specific topic in order to analyze the link between the profit allocation and the intangible. And we try to divide some specific topics divided in three separate segments. The first segment is related to the accurate delineation of transaction. The second segment is related to the OECD new guidance, revised guidance of profit split. And the third segment is focused on the COVID-19 impacts on the business that involve directly intangible. In the first segment, Isabel Berlin then tried to explore the topic related to the accurate delineation of transaction, focus the attention on the value creation and business model. In the second segment, the professor Vikram tried to analyze the revised guidance on profit split, but with a focus on digital business model. And in the third segment, Jean Paul Westering from Nestlé, Giuseppe Battista from Ferragamo analyzed the impact or tried to help us to understand better the impact of COVID-19 in the business model, contributing with their point of view related to the specific business in which they are involved. And obviously, it's important also to have a discussion between the panelists, among the panelists and the attendees. And I think that we can start immediately with our conversation. I leave the floor to Isabel with the accurate delineation of transaction that involve intra-group intangible asset. Thank you, Isabel.
Thank you, Gabriela. Thank you so much. And thank you so much, Vikram, and also Professor Danon and colleagues for this great initiative, and particularly for having opened the registrations to everyone for free. We do appreciate that this is not as straightforward as it may sound, but it gives a lot of people, young practitioners, the opportunity to be part of very interesting panels and probably thinking about how they're going to deal with all these conundrums within a few decades from now, when people like myself will for long already enjoying their retirement. So thanks again for that. So with the delineation of intra-group intangibles, as Gabriela rightfully said, I'm going to try to specify a bit the thinking around that as a practitioner. So if I could get the next slide, please, that would be great. So what I'm trying to gonna do over the next 10 minutes or so is talk a bit about value creation, DEMPEs, versus what I would call the true factors of economic productivity. Yeah? Because we should not forget that the OECD, and this might sound as more harsh criticism than what I want to say, but the OECD is relying on a very unspecific notion of economic substance, for which the concept of value creation is then used as a proxy. And for that, we need to enter into that sort of DEMPE analysis. And as Vikram was rightfully saying this morning during this fantastic first panel, there is probably a likelihood that uncertainty is will be the result of all that. And that's what I'm trying to explain now is how do we deal with it in practice? So companies are constantly thinking about, well, how can I access the location of my brain power in an optimal way? I wanna optimize my performance across my countries, and this DEMPE requirement is probably then more than just an exercise of ticking boxes. And this is why I put also on this slide that understanding a business model and laying down the building blocks for a robust internal governance of that, it's easier said than done. So it is unclear what creates intangible value, and the reason for that is think about the current digitization of the economy, where human interaction seems to be a bit watered down compared to what you achieve through technology. Think about data lakes, think about that sort of capital that is indeed getting more intertwined with human interaction, but watering down a bit the pillar of human interaction in there. And so therefore what I want to get at is, shouldn't it be a good moment to think about a value creation in a sense of what is the bargaining power of the various entities throughout my value chain? So if I'm trying to make the analysis in the heads of an IP owning company, where does this company sit in the value chain? What sort of barriers to entry does this company enjoy? And that's exactly what I would like to share over the next 2 slides. So what could be a good idea is to start with, like, what is my catalog of services? What are the capabilities that I have in my organization? And I have to align on an optimal delivery model for those services, for those capabilities, and that includes the role of shared service centers. Think about the United Nations Transfer Pricing Manual, and where it touches on certain country practices around shared service centers. So it is probably in the mindset of a transfer pricing practitioner fairly easy to say, oh, that's going to be cost plus. But if you bring it back to the whole discussion, like, what does it mean in terms of creating economic rent in an organization, you might to have a very comprehensive analysis of that. So, and then you can develop the plan to bridge the current situation to the future state for key services and capabilities. So if I'm going a bit more into detail, and this is then what I'm trying to say in my next slide is, well, the arm's length principle is seeking to allocate profits to value creation, as we all know. And to understand the value creation at the level of the IP owners or at the level of entrepreneurs in centralized groups or both, it is critical to map those roles that are pivotal in the respective jurisdictions where I am operating. And in transfer pricing terms, we usually make a sort of a bottom-up approach, because we are going to focus on key assets, we're going to focus on risks, we're going to focus on functionality, in terms of understanding the value creation in the existing businesses. So if I have intangibles, if I have brands, if I have patents and all those things, who is overseeing the ultimate decision making? So very much a bottom-up approach, as I was saying earlier. But the question is whether it wouldn't be a good idea if you bring this into the equation of a discussion around economic rent capturing and assessing the relative bargaining position of parties, to also include a top-down approach to that. So appraising the fundamentals of the value creation is probably something that also commands a wider grasping of industry evolutions and thinking about value creation from that angle as well. And then you bring the two together to create a foundation to test which roles are actually to be assumed at the level of the IP owner, and which one can be more proliferated in geographic terms, so to say. So what I'm talking about here is, you can have a discussion on what is the value of an IT department, or what is this functionality entailing. And I was listening in very carefully to the previous panel that was great on services, but there is probably not a kind of a one size fits all. Think about people who are writing algorithms that are self-improving. So bringing the value proposition to a higher level, while, as I said earlier, marginalizing the added value of the core DEMPE. So what am I going to do with that from an IP perspective? Think about flexible supply chains, think about flexible innovation models, omni-channel sort of sales capabilities in an organization where I have to swiftly adapt constantly to a market where this sort of consumer sentiment, consumer preferences are changing over time. Until a few months ago, I never heard of the word Instagrammability. Well, I was doing a functional analysis and a chief marketing officer said, it's all about Instagrammability. And I was asking, yeah, but what are you doing then? And this is, you might laugh at this, because this is something that is indeed very important to see. How am I working with my influencer, and what does it mean in terms of my brand equity creation? So, but also in the context of marketing intangible, manufacturing intangibles, this can be extremely relevant, because how I build up my competitive edge commands a very qualitative analysis. What is the value of my resilience of my supply chain? How important is it that I have a backup contingency plan, particularly now in those uncertain economic situation caused by the pandemic? So what is my my digital data and analytics sort of functionality heading to? What do I want to achieve? And particularly the very flexible decision making, extremely important. Faster decision making, and once again, COVID might be very important. Think about the whole environmental, social, governmental sort of angle that kicks in here as well, because single use of plastic is something several companies are getting away from for very obvious reasons. But all of a sudden, when restaurants are closing down and we all have to rely on takeaway, does that mean that companies like Jean Paul's all of a sudden have to think again about single-use plastic, or what does it mean for us? So, final slide on that then, in terms of how to proceed, is 6 steps basically, and I'm not pleading for a complete overhaul in the way we do functional analysis. It's just a best practice model of how most companies these days think about capturing DEMPEs in these sort of flexible environments. And so, first of all, on the value creation within the group, we have to think about the fundamentals. So we look at industry evolutions. How are business models likely to evolve in the future? I could talk for hours about that, as you perfectly imagine, but as I gave a few examples already, how can this be turbocharged by, for instance, the pandemic? And I'm sure my colleague panelists will talk about that at length. Then the core value map for my organization is going to be important. I would like to interview a very limited number of executives to see how their sense is about this sort of industry evolutions, and hear it from the horse's mouth, to say how they take this further. And then I'm going to look at the market. I'm going to look at the peers, and these peers may not necessarily be your competitors. I'm also not talking about industry averages in the context of the OECD comparability chapter. I'm taking it broader, a sort of a peer group. Where are the competences, the core competences, the sustainable sources of competitive edge that you have and that your competitors claim to have? Can be competitors in parts of your value chain, or it can be competitors as a whole. And then I'm going to look at your groups, at the company's value map. So broader scale interviews to identify those elements that are driving this competitive edge across the different aspects of the value chain. So what you could think from the outset not being an intangible may very well be an intangible. What you might think of a very important patent might at the end of the day be something which is legally protected, but not much more than a best practice, so to say. And then I'm going to link that functionality ultimately to value creation. And I'm going to see whether I have to put certain of these contributors to and decision-making elements, for instance, in my master file, because it can be a very, very important step in making tax authorities across the world understand where my value creation sits and how I think about this in a dynamic context. And then the final step is the identification of the key roles, the key functionalities, the key teams to be located at the IP owning company or the entrepreneur or both, and where can I have a more sort of proliferated part of my a more proliferated presence of my human capital in my organization. So these are only 3 slides, and I only had like 10 or 12 minutes, Gabriela. I'm sorry for that. I would like to apologize with the audience. Once again, I could talk for ages about it, but when I look at this, I have a question, if I may, Gabriela, to give the floor straight away to Vikram to think about this sort of approach to DEMPEs. Compared to what we see, for instance, in relevant case law these days. And Vikram, you asked me to introduce the Coca-Cola case, which I was not very happy to do in the first instance, because I prefer cases where taxpayers are winning, but the fight is not over, let's say, let's put it that way. But when I read the Coca-Cola case, and it's a read of 244 pages, and I must say I enjoyed every single page of it. It's about the Coca-Cola company owning marketing intangibles, owning all manufacturing intangibles, but working with a number of supply points throughout the world, 2 important ones in Brazil and in Ireland, respectively. So they're using the concentrate. They are producing the concentrate thanks to the IP made available by the Coca-Cola company in the US. And then this concentrate is then going to the independent bottlers that are then selling the beverages. And for the remuneration of the supply points, the IRS was of the opinion, as confirmed by the court in the first instance, that a CPM method was more appropriate than a comparable uncontrolled price, for the sheer reason that the supply points were no legal owner of IP. Moreover, they didn't have any economic ownership somewhere in their balance sheets. And another element was that some of these supply points were allocated more capacity to the detriment of others without being paid any compensation. So bringing this to my discussion, this was what I read in those 240 pages is very much something like, what is now the relevance of a supply point? Rather than taking it from the perspective of a sort of an economic rent creation and the value of that within the value chain of the entire company. Sorry to be so talkative in such a limited amount of time, but with this, Vikram, I would like to give the floor to you, if okay, for Gabriela.
Sure, thank you. Thank you, Isabel, for giving the floor back to me. Actually, in Coca-Cola's case, more broadly speaking, it's a sort of decentralized kind of business model. And usually in the decentralized business models, what I've seen, at least based on cases and me talking to a lot of TP professionals, is when you have a headquarter company, let's say in the US, and you have a full-fledged manufacturer, let's say in a developing country like India or Pakistan or Bangladesh, it's usually the transfer pricing adjustments that are being made at the Indian level or Pakistan level or Bangladesh, and so on and so forth. But the Coca-Cola case is interesting here because in a decentralized kind of setup, you are seeing the US actually making a reallocation of profits back from the supply points back into the US. So it's the other way around. And if I go through the US rules, the legal provisions, they're actually very well authorized to do so. And the US arm's length the way the arm's length principle is applied and interpreted in the US is quite broad as compared to the other parts of the world, at least in some of these cases which I'm seeing. Not only in Coca-Cola, but there was another case on Amazon also, which was an intangible related case where a reallocation was made back into the US with respect to Amazon's IP related profits, which are being booked in Luxembourg. So at the US level, we see this trend right now where reallocations are being made back from European countries or developing countries back into the US under the transfer pricing rules. So coming to the DEMPE concept. So where does the DEMPE concept fit here? Before I start my slides and speak about the profit split method as such, the DEMPE concept is essentially an income allocation tool. Now, this income allocation tool with respect to intangible related income fits, very well with centralized business models. In the sense, if you have a principal and the principal has all the key decision makers with respect to DEMPE functions, then a bulk of the intangible related income should be allocated to the centralized entity as opposed to the low risk contract manufacturers or low risk distributors. But when you start moving into a decentralized setup, I think this is where DEMPE is really going to be a key challenge. And this is where, Isabel, your diagram where you spoke about the 6 different steps on identifying DEMPE functions really would actually fit in, especially in this kind of setup, in a decentralized setup, where you really need to reallocate profits, where you need to allocate profits between the headquarter entity and the local entity based on some kind of profit split, because in a decentralized entity, the local entity on the ground is doing substantial business activity. And this is where I will get into the discussion on the profit split method, because in a decentralized setup, I think one of the main methods going forward is going to be the profit split method. Historically, even in decentralized setups, what we've seen is that there's been extensive use of the TNMM, transactional net margin method. Once again, if you have a US headquarters, you have let's say a full-fledged manufacturer in India or in any other developing country or in a developed country, we've seen the use of transactional net margin method to justify the transfer pricing policy of the local entity on the ground. But going forward, I really feel that the profit split method is going to play a major role. So if you could just go to the next slide, please. Well, just to come back to the basics, transfer pricing is essentially a 2-step analysis applying the arm's length principle. Firstly, it's to accurately delineate the controlled transaction. And the second step is pricing the controlled transaction by choosing the correct TP method. Now, in the past, most of the issues were in relation with respect to intangible related transactions. At least on the basis of case law, it was mostly related to step 2, where you're always checking whether the royalty is at arm's length, or whether the sale of products which embeds some intangibles, whether that's at arm's length, so on and so forth. But now the focus is moving into step 1, and this is actually the bulk of the changes which took place in the OECD's BEPS project were actually related to step 1, which were actually related to the accurate delineation of the control transaction. And with respect to intangible transactions, this is where the DEMPE concept actually fits in. It's within step 1. It's not really in step 2. It's within step 1. And step 2, there could be some spillover effects, but step 1 is where the DEMPE concept actually fits in. Now, with respect to the profit split method, if you could just go to the next slide, when does it actually apply, the profit split method? It actually applies in a situation where both the local entity on the ground and the headquarters entity in our examples make unique or valuable contributions, or when there's a high level of integration with respect to the business transactions, or if there is some shared assumption of economically significant risks or separate assumption of economically closely related risks. Now, this is this I've taken out from the OECD guidelines itself, the transfer pricing guidelines, as well as the recent report of the European Commission on the profit split method. It's very nice and sweet of these indicators being highlighted in the report. But the main issue here, which I feel with these indicators, is that there's an overlap among them. And there could be many situations where there could be one fact pattern, and that one fact pattern could actually be covered by all the three situations or one of the three situations. So the way the profit split method chapter has been written, I feel it's good. There's been some indications when the PSM is applicable, but there are a lot of overlaps between all the three indicators. For example, without getting into details, if you take example 10 on the profit split method report, there is an overlap between all these indicators. Next slide, please. With respect to approaches to split the profits, as we already know, so I won't really get into the details, there are two approaches, the contributional analysis and the residual analysis. And with respect to the contributional analysis, it actually starts, or one of the ways to apply the contributional analysis is to find comparables or determine the relative value of two associated enterprises to, or the other associated enterprise to the controlled transaction. A contribution analysis, at least based on my discussions with a lot of people, is quite difficult to apply. And by default, a lot of times people are resorting to the next method, which is the residual analysis. The contribution analysis, I've also seen it in a few instances, and these instances have been reported in the transfer pricing guidelines itself. But in a lot of other cases, which I'm seeing, that I see there's a rise in applying the residual analysis. And if we go to the next slide, please. With respect to the residual analysis, once again, it's a two-step analysis. In the first step, if you have two entities, one a headquarters entity and a local entity on the ground, then you would allocate a routine return to both these entities, and then you come up with a residual profit number, and then you split the residual profits by using a certain specific allocation key. And this allocation key depends on the facts and circumstances of each case. And this allocation key could be based on assets, costs, or sales, and so on and so forth. If you see here, and this is where I would like to make a comparison with amount A of Pillar 1. If you look at the residual analysis under the transfer pricing rules, now this residual analysis follows a facts and circumstances analysis. Now this facts and circumstances analysis doesn't give you one standard answer for all situations. It actually depends on the taxpayer's particular situations. Now, if I do a comparison with amount A, which is also using a residual profit split method, but on a deemed basis by using some predetermined formulas, not by resorting to the arm's length principle, the foundation for amount A allocation is actually the residual profit split method. So they've leveraged on the residual analysis, which is there in the transfer pricing guidelines. The residual analysis is not so easy to apply. So, if I have a discussion with all the panelists here on a particular fact pattern, Jean-Paul will give me one answer, Giuseppe will give me another answer. I'm sure Isabel will also give me another answer. But when it comes to amount A allocations, because the percentages will be fixed and the formula will be used, so it becomes easier to apply it in an amount A context because they're fixing the formula. Whereas the residual analysis under the existing rules, since it depends on the facts and circumstances of the taxpayer, it could quite be difficult to apply. So you would really need to know how you really need to. A lot of examples will need to be given on how this split would actually work, and this is where I would have a recommendation to the OECD, is that they have nice examples in the profit split report, but these examples are just pretty simple and easy, but they do not really reflect a lot of real life situations. So I guess they should really take over the discussion from, or they should really invite multinationals to, or the big fours to come and give information to them on how this is applicable, the profit split method, and so that more examples can be provided in the OECD transfer pricing guidelines, and which could be used by tax administrations around the world. Because the way now, at least in the case law, because there's a lot of case law also, which I would just like to come to, and a lot of cases In 2020, like in India, there was a Toyota case. In Italy, there was a Trans Alpino case, and then there was a zinc smelter case in another country, and then an orange case where they have used, tax administrations are starting to use the profit split method quite extensively. And so my only recommendation at this stage would be to provide more examples, more guidance on how this method would actually apply in real life transactions. If you go to the next slide, please. So that was the theoretical part. Now, if you just move a bit on the digital business model side, if you go to the next slide, please. We have a case where we have example 5 of the profit split report. It actually deals with the situations where we have WebCo, which has developed an IP like a crawler, and it has there's a ScaleCo, which actually develops the second version of the web crawler. And finally, the web crawler is monetized by selling it to the final consumers, and who actually pay at ScaleCo. And then the question is, how do you split the profits between ScaleCo and WebCo? There you apply the profit split method, because both the companies here, WebCo and ScaleCo, contributed to the development functions of the software. If you go to the next slide, please. Another example, where it's not really with digital business models, but it deals with a situation where you have M&E group that sells electronic appliances. You have company A, which is engaged in the business of which designs, develops, and manufactures a product, whereas company B, which does the marketing functions and sales. Then in this case also, the use of the profit split method is actually contemplated. Now, why am I discussing these two examples is because I would like to get into the case studies in the next slide. And this could be interesting when we talk about digital business models, because the foundation laid into the two previous examples, I used them as a starting point for a discussion on the online advertising scene here. A classic business model which is followed by an online advertisement company like Google, Facebook, so on and so forth, is that company A could be based in Ireland, for example, within the European Union. Company B could be in France, which is doing the local software service. It's a local marketing service, marketing and sales services, as well as some customization services. Which TP method would you apply here in this case to actually split the profits between company A and company B? Just keep in mind that here, company A enters into transactions directly with the clients and it receives business income. And company B is actually providing software and marketing related services. Well, if the activity is carried out independently by company B, then there's a strong case to argue for the application of a profit split method, in the sense that if the marketing services are provided, if you have local people on the ground who are responsible for providing marketing services, or local people on the ground who are responsible for software services, and they're performing these services independently without a lot of intervention of people from company A, then in that case, there's a strong argument of applying the profit split method, because both companies arguably are making unique and valuable contributions, or to a certain degree, their business operations are integrated with respect to the final realization of the profit. Now, in a recent case in France, this was picked up, and there was the court recently has actually said that in this kind of situation, the activities which are being provided by company B could actually trigger a permanent establishment for company A in country B. In this case, if a dependent agent permanent establishment arises, then once again the question arises, how do you go about allocating income to this dependent agent permanent establishment? Well, the dependent agent permanent establishment has not done any functions as such, because the functions are being done by company B, and company B will be rewarded for the income. I personally feel that no further income should be allocated to the dependent agent permanent establishment. But the way the OECD has written its report on BEPS Action 7, the additional guidance on profit allocation, tax administrations will definitely argue for higher income allocations to a dependent agent permanent establishment. So essentially, all the income that is being sourced from the business clients in country B could be allocated locally by the tax administrations. And of course, the case will go to the court, and then we will enter into a big discussion. Next slide, please. Another example where, with respect to digital business models, and then I'll stop, is in relation to an online company which has a warehouse in, let's say, in country S. And from this warehouse, there is some storage and delivery activities that take place locally to clients. And then the clients directly enter into contracts for buying goods from the online retailer. In order to remunerate the local PE, here, which is the warehouse, it could be a local PE or it could be a separate legal entity which houses the warehousing activity. Usually you would apply the transactional net margin method if you're just doing mere storage and delivery activities. On the other hand, this is where I think Isabel's six-step framework actually would really make sense. Is by applying the six-step framework is to check whether there is a lot of whether there's any other further activity that is being done locally, because there could be situations where the people in the local warehouse, they're not only doing storage and delivery, but they're actually doing something more. If they're doing something more, like for example, marketing and sales, or if they're doing software development, so on and so forth, then and if they're doing it on an independent basis without really intervention of the headquartered or the parent entity, then in that case, you could possibly end up applying the profit split method based on the value of the functions that are being carried out locally. So, so if you just go to the next slide. So just to conclude my presentation, I would just like to say that we have so far seen the extensive use of the transactional net margin method to allocate profits to local entities. We've seen that a lot. But I think in the future, we are going to move towards the profit split method, and especially with respect to intangible transactions, because like Isabel said, it's very difficult for you to ascertain where you're creating intangible related value, especially in decentralized setups. And in a decentralized setup, the tax administrations of the local entities will definitely argue for the application of the profit split method. And this is where I would just ask the policymakers to provide more guidance and more numerical examples of when this method applies and when it does not apply. With that, I will stop my intervention right now.
Sorry, I would like to ask you, to all panelists, if after the discussion and exchange of thoughts had with Isabel and Vikram, in your opinion, the figure, the situation related to the low risk function exists in a decentralized model? Is possible at the time to consider the existence of low risk, for example, distributor, if we consider what Vikram mentioned before, the situation in which, for example, a point of sale perform different function, where different risks are related to activity related to marketing and so on. It's possible to individuals now in this model, in this evolution of the economic model of the group, this kind of function. I consider this topic very relevant also when we discuss about the possibility to extend the use of the profit split in the new model. Traditionally, the profit split method is a method that the tax authority try to apply in two different situations. First, when there are a unique intangible, and recent trend observed in different jurisdictions when had the difficulties in applying the TNMM, and then try to individuals a method more simple, but the profit split, the correct application of a profit split is not simple. It's important to have a lot of information, and it's important to, as Vikram said before, consider the characteristics, the fact and the circumstances that are related, strictly related to the function performed by an entity. And,
if I may, Gabriele, if I may comment on this. and then I'll let the field to Jan-Paul, who is certainly more familiar than me with decentralized business models, which Nestlé is having as well, is implementing as well worldwide. But I think that here, of course, a decentralized business model is more likely to be the first field of expansion of the profit split methods in the future, especially because new intangibles or new soft intangibles, new soft marketing intangibles, also through the digital revolution, are allowing a lot of multinationals to expand their business to achieve profitability even in challenging times. On the other side, what I see is that in centralized businesses, COVID-19, I think that showed us that centralized businesses are still centralized businesses. And the risk that I see on the horizon is that many tax authorities will use the losses achieved by limited risk distributors and other limited risk entities by a tool of demonstrating that a profit split method may be applied, because you will have businesses saying, okay, we're gonna go for pain sharing. Those are limited risk does not mean zero risk, as everybody is saying. But I think that here it's very important to learn a lesson. We learned a lesson that in recent years, BEPS, OECD, and all of us practitioners, I think that underestimated the market risk. Market risk is still a risk. And it's typical the risk that in a limited way, a limited risk distributors assumes. So when the market collapses, and this is actually one of the few passages that I really liked in the OECD guidelines on COVID-19, which was highly political and not very conclusive, I think we may all agree. But with this respect, the underlying that the market risk is still a risk, and the market risk here is working, and the demand was collapsing in so many markets for so many businesses, that this was driving the result, this was driving the loss, and not the presence of some soft intangible or some higher participation in the overall risk of the multinational enterprise by local limited risk entities was actually happening. So in my opinion is, first, let's say attention field is decentralized business models are gonna challenge profit split method application challenges by tax authorities everywhere. So maybe something can be done in advance by consultants and tax directors in order to anticipate this or to do something smart, like some variations that eventually will lead in a more sharing of the profit without applying the very complex profit split method.
Just to add to what Giuseppe was saying, I mean, yes, I have a bit more probably experience in the decentralized organizations, but I think in a centralized model, it's really coming down to looking at obviously where the function is performed and who's actually contributing to the value. And what Vikram was saying earlier, then it's easier to see that the DEMPE functions and the value contributions are done by the central company. I think in a decentralized model, it's more likely or there's a better possibility to go to look at a profit split model. And I think it's also now you see with businesses, they are not, there's not a one size fits all for companies, for multinationals. You cannot, also within a multinational organization, you cannot always have it the way you want it as a tax guy. You cannot always say, I want these R&D guys or these value contributors in this location or in this entity or there. So there will always be a balance that you need to find, and also with where is the value being contributed. And I think that's also looking at the 6-step overview from Isabel. It's really looking at the value contribution in the organization. So what are the key value drivers in your organization? and who is actually taking part in contributing to the individual elements. And that can be separated or can be split. It's very difficult that you will always have everyone in the right place. So I think personally, a profit split, I like it. I mean, you have the two-sided approach. You really need to look at it for this specific company or for this specific organization. And it will always be different, and businesses change over time. I used the profit split previously in my previous life in an organization that was moving towards a more centralized organization, and we knew where we wanted to end up with over time. But this gave us a possibility to actually implement a model which you could then adapt the split part, let's say, over time based on the movement or the centralization. And you see organizations, also in our organization, in certain areas, there is more centralization happening over time. If we compare with 5 years ago, 5.5 years ago when I joined Nestlé compared to now, there are areas which have a much stronger central contribution. And you need to be able to cater for that in your model as well, I think, because you cannot change your transfer pricing model every 2 years. I mean, yes, technically you can, but if not needed, I would try to avoid it. But I think with this profit split, and we'll talk about later on, but we have a kind of a profit split. It's not a real profit split, but it's a profit depending structure. But the challenge there, and Vikram raised it in one of his earlier slides, is how to implement it and how to determine the value contribution. And that is a thing that in discussions with a lot of countries, we have seen everybody looks at it differently. Because how do we determine the value contribution of the two parties? Only looking at DEMPE functions is not sufficient. That's really looking at only the intangible part. Or the intangible, the intangible part. But there's a lot more areas where value is being created and contributed by the two parties involved. And I think to find that out, we have been really looking at and working with this process contribution analysis. Who's contributing to the value contribution, to the value drivers in your industry and your business? But there is a subjectivity in there, and tax authorities don't like it. So some say clearly, we don't like it because it's too subjective, but we also don't have an alternative option. And I think that is an area where I would very much like to see if there are also the OECD maybe or someone else, if there's more guidance to get a more objectivity in there. And if it's difficult, I think, but that we together agree, okay, what kind of options or possibilities do work or we do accept. Because it's difficult if you want to implement a certain model globally, that with each and every tax authority, you have a very different discussion or a battle or negotiation on how to determine actually the profit and the value contribution by the two parties. And I think that is an area which makes in my view, a broader application of a profit split model quite challenging.
Yes, I would like to add only one my thoughts related to the use of the profit split by the tax authorities. Probably considering what we say during this panel, it's very interesting the use of the profit split as a solution of a lot of problems in terms to allocate the profit in all the components of a multinational group. But
can I respectfully intervene here, because that's not what I said at all, Gabriela? Sorry, but I think
yes. Sorry, Isabel.
Because when I gave Vikram the floor, it was more to comment on the on my piece rather than already jump into the profit split. And therefore, if you allow me to come back, because I think maybe it's semantics, but there is a bit of confusion that I think here. And Jan-Paul, you said it's not a true profit split. I think what you said was, we are not necessarily testing the profit level indicators at all the levels, at all the intervening parties, but we're going to do a qualitative analysis of the non-tested party to then see what sort of transfer pricing methodology I have to apply. I think this is a fundamental distinction with profit split and increasing empathy with profit splits, because we should not forget that going back to the OECD basics, there was at a point in time in the profit split paper a reference to the benefit of a value chain analysis. It was taken out there, luckily, and put in chapter 1. Because this is in the introductory chapter, this is important. This is looking at my value drivers. And I am making this qualitative assessment. And then I am making the call, am I going for a one-sided methodology or am I going for a full profit split? That's, I think, a fundamental distinction with what I heard a few minutes ago. And sorry, I think that's why we have these sort of panels at universities. So allow me to be a bit challenging here. But in your example on online advertising, Vikram, you said perhaps for the software services in the other country than Ireland, in your example, perhaps this would be good to have a profit split because you are reaching advertisers in that other country. It may be the case, but it may equally not be the case because it may very well be that these people are exercising more support services of a technology software platform, a whole ecosystem that was developed in Ireland in your particular case. So I'm not making the call to say it should be one-sided, but I am far away from saying, oh, let's jump on the profit split wagon. And I think that's a very fundamental distinction in this whole discussion. So sorry to have intervened, but I wanted to put that very firmly, at least from my end.
Yes, and just to complete Isabel's point of view, it's exactly in that direction that, as I was saying, since I am expecting, because of course I'm talking about future risk since I am a tax director, so that is my obsession, future challenges, future tax assessment. So I was suggesting, since more profit split method challenges will come, then why not stick more to that kind of value chain analysis, 6-step approach, and core leverages of added value that may call for more than one entity along the chain to get a variable profit and on a fixed return, but that would not mean to apply profit split. So let's split the profit in order to avoid the pain in the BIP profit split method to be applied.
Did we take your breath away, Vikram? I'm sure you're wobbling on your chair to intervene on this one.
Yes, actually, I would just go back to the example in which you had in which I had put up, where you have like the Irish head office, where you have a lot of technical and marketing people sitting there, and they're doing their work, and then you have a sales entity in France, and this local French entity is, in my example, was doing software and sales related services. And actually, the point which I was trying to make there is that if the local entity is doing software and marketing services, which are quite independent in the sense that the local people on the ground, based on a analysis of the key or based on the functional analysis, if that would lead to the conclusion, if the local entity on the ground was doing a lot of software related activities such as providing suggestions and assisting on adapting algorithms, technologies to cater to the local market, or introducing new features that would be attractive to users in the market, or if it's doing marketing and sales activities such as advertising, promoting the use of online services, translating services in the local language, tailoring them to local cultural tastes, negotiating sales with potential customers, and so on. And if it's doing this actually on an independent basis, what do I mean by that is they are taking the decisions by themselves and not really consulting the head office, which is based out of Ireland, then in that case, I would say there's a good chance of applying the profit split method in light of the indicators being used by, being provided by, because in this kind of situation where the local entity is really doing a lot by itself on an independent basis with minimum involvement of the head office, then you would go ahead and apply the profit split method. And this is typically a feature of a decentralized setup where the local people on the ground, they are being involved in sufficient decision-making activity in the sense that they're doing it independently. And this is where the DEMPE framework actually sits in. Because when you do a functional analysis, you'll also have to do a DEMPE kind of study to see what leads to that conclusion. Then there's a good chance of applying the profit split method. So I'm not saying you throw out the TNMM. The TNMM could well apply in a situation where the functional analysis, the DEMPE analysis, would actually indicate that the local people on the ground are, mostly working under the direction, supervision, control of the entity at the head office level, and then just executing routine tasks.
If I may, just 1 second. If with all these ifs, and if they work independently and they're targeting other advertisers, and then I agree with what you say. Then there might be some empathy with profit split, but in the natural course of events, we're talking about global advertisers using these global platforms and things like that. And that was the reason why I felt the temptation, more than the temptation, but the need to intervene. So I think we closed the circle on this one. Then thank you for that.
Yeah.
Okay. We can start with segment 3. We can anticipate some concepts, but probably we can start with the presentation of Jan-Paul Westering, and then we discuss and try to provide some answer to some questions that arise from the floor.
Great, thank you, Gabriele. It's what I wanted to do is talk a bit about the how we as Nestlé have experienced or been challenged by COVID-19, and then also talk a bit about what were the challenges that we've seen on the transfer pricing side, and coming back then also to the intangible, but also sides, how we managed to deal with it, I think, or what made our life probably a bit easier. Just a bit of background. Nestlé, don't know everyone knows it, but we are a consumer goods company selling a lot of products like coffee and Nespresso, for example, and Nescafe, but also confectionery, chocolate, Kit Kat, and a lot of other chocolate brands, but also infant nutrition, for example, but also water. So it's a very diverse spectrum of products that we're selling, but also we have a lot of different models, business models, tax models, let's say. But we also on that have quite a bit of different sales channels or routes to market, and that mix has probably helped us also during last year already, and this period now. I mean, certain products have gone pretty good or pretty well. I mean, I've been sitting most of my time since March at home, and I do like do need my regular cup of coffee to stay awake and keep the energy flowing, but I need to have it now at home. So also my personal consumption of Nespresso capsules has increased significantly. And seeing the business, it has been a lot of other people have done the same. See Giuseppe already smiling, I think. But we had certain areas that have gone very well. People have been had to force or be more at home. Restaurants close in a lot of countries, so you have to eat more at home. So the at-home consumption and own preparation of food has definitely increased. So that has benefited us. But also the e-commerce, we saw we were doing a little bit of e-commerce, especially with Nespresso. But you saw, of course, that now a lot of other markets, businesses have been looking at, okay, we need to be able to supply and reach our consumers. And e-commerce is a good option in that sense. So that has been further developed. So that also has for us further implications and food for thought and raises attention for us as well to look at that also with respect to the Pillar 1 discussions. We were already thinking about it, how could it implement and all. But now, of course, this accelerated certain areas. But there's also a very interesting how certain markets have been challenged or impacted by this. Certain countries where you have seen a lot of that people started hoarding and stuffing up on a lot of food at home. So they saw an increase in sale, but the other countries, it really has gone down. So it's a very interesting perception there, what the implications were. But you also saw clearly that certain businesses obviously have suffered. We have an out-of-home business that supplies hotels, restaurants, cafes. Clearly, with a lot of these restaurants and cafes and bars and hotels being closed, that was impacted significantly. A business focused on international travel and retail. Yeah, I mean, I guess most of us on the line have not been in a plane for quite a long time now. So clearly that is suffering significantly. And as I said, certain countries have suffered more than others, and other countries have been doing well because people started preparing more food themselves. And you have a bit of a pity eating, maybe you snack a bit more during the day because you're at home, you have access to it. So that has been helping us. And looking at them, also on the other point that we as a group, it was quite quickly decided we will not try to make use of governmental support or benefits like financial support with or delay with payments for your obligation on the VAT returns or assessments or tax returns. Because as a group, we said we have a responsibility also towards community. We can fulfill our responsibilities, and we will do that. And I also saw going through the OECD guidance, also saw a lot of the points, or there was an area there covering that as well, how to deal with this. So that's something for us was not really an issue because we didn't have to think about it, how to split or if one benefits from it, should we take that into account in our transfer pricing transactions as well. So that was a pretty good one in our favor in that sense, in our benefit. But clearly with the whole COVID discussion, we had a lot of situation. Clearly there were a lot of additional costs involved for this. Cost for getting all the equipment in to be able to protect the employees, temperature machines when you come into the facilities, the masks, the hand sanitizer, everything. Additional cleanings, but also with the supply of the products. Obviously, we are in the food and beverage industry, so it's vital and was crucial to maintain the supply to our customers. And yeah, you need to make sure that you are able to keep supplying. So the insurance supply was a big driver for us to make sure that we do this. So, and making sure it added costs in logistics, and getting the right products, raw materials in a different way if one supplier wasn't able to provide it. So that has increased costs. And that has had an impact also, of course, for us and looking at the transfer prices, because we have in our part of our business is decentralized. And we have a finished goods transaction model, let's say contract manufacturing transaction there. Because we have a lot of factories, they're producing products, and then they sell it to a lot of other Nestle entities. And to be able to calculate the costs, you can always say, yes, we created a cost plus, we have a cost plus implementation model. And we say at the beginning of the year, we calculate based on the budgets and the forecast, and then we do a regular true up. It's fairly standard transaction model in that sense. But at what point in time that we had to start adjusting and reviewing and adjusting the prices, because early on we didn't have enough insights or any insights in the forecasts going forward because nobody knew how this would develop over the year. We saw that certain cost elements had increased, definitely, like I mentioned here on the slide, but we also saw that in certain areas, certain raw materials prices had decreased. So you could actually see that in quite a lot of situations, for the factory, the overall cost had not increased. In some situations, even decreased because of the benefits of a decrease of raw material prices. For example, oil was going down quite a lot in the beginning of last year. So that had quite so that made us also really think during the year, at what point in time do we start adapting our pricing model, if at all? And obviously we wanted to first get a better insight in what was happening, what was going to happen, and how were we then and then to assess how to adjust our model, if at all, and how to actually deal with it. You saw it also, and sorry, I'm already on the next slide, Gabriela, some certain topics, I think. But so we also, let's wait, take our patience, let's not react too quickly. Especially on this, for example, the sale of finished goods, this contract manufacturing transaction. Let's first see what will happen during the year, and then we assess later on. So actually during the year, it was not too bad. So we decided, okay, let's leave it. Because then also you have the question on the comparability coming up on the markup applied. Should we adapt it? Reading also in the guidance, again, the OECD guidance, do we need to do something in our benchmarking or not? Luckily, I think we are in the industry. I mean, that has not suffered significantly, definitely not. And I know certain companies have suffered tremendously with sales going down 30, 40, 50 or more %. So then it's a different situation probably. But in our situation, we said, okay, let's look at it, keep it, and try to keep consistency. Even if you have later on new benchmark studies coming up for a contract manufacturing transaction that might obviously might see a dip or not. I prefer to keep that consistency over years. I mean, it maybe has a 1 or 2% impact, but it's not that material, I think, in that sense. And consistency, I do prefer keeping that. But also, I mean, on the other side, the forecast still for this year, it's difficult, and we've seen that also with the other intercompany transactions. It was very difficult to forecast, and with some transactions, yeah, with an LRD remuneration, you need to know the forecasted sales and profit numbers to be able to adapt your pricing in the intercompany transaction. So we said, okay, let's wait and see for that as well during the year, and then try to resolve that at the year end. One of the areas that I think it's not so strong dealt with, I think, or discussed, is on the people side. Obviously, we had people that got stuck in the wrong places early on, and the lockdown and the first wave or waves. And taking that back to the DEMPE discussion, you run the risk suddenly, if you have a head of a business unit sitting in the wrong country, that it would disturb your DEMPE structure if you would strictly stick to that. And I know quite a lot of countries have come up with guidance and say we will have to be flexible, take that into consideration, that people get stuck, but some countries have extended those regulations. Others, you haven't heard anything about it anymore after the first time they issued this for 60 days, 2 months, 3 months period. So how will they look at it with hindsight when they start looking at 2020? If you have certain people there stuck in the wrong location for a certain period, we have been taking a very strict rule on that. As long as somebody's in the wrong location, very strictly, you have to stay away from strategic decision making, signing contracts, all these typical kind of things, let's say. But it is an area where I'm not sure how countries will start looking at it, and obviously we'll prepare for that ourselves. But that's an area where I'm a bit afraid of, maybe. And also you see that in certain countries, there was a very, very strict lockdown. So the business wanted to offer certain employees also the possibility to work longer from their home country. And that's something we have to deal with. Obviously, from a business and employee point of view, you fully understand it. But also, it's not the easiest way from a tax point of view, that we need to deal with it and make sure that we cover it correctly and that we're not jeopardizing anything in that respect. But that's, again, this topic, how will countries start looking at it? I'm fearing it a bit that they will really keep focusing on this, because they know that the situations have been occurring. It has been in the press in a lot of countries. The banks in England calling back their employees who are working from the Caribbean beach houses, of Mediterranean beach houses. Some countries now say you can work from companies say you can work from anywhere where you want. So there is more focus on this now going forward. In the past, I was not so worried about it, but now I think it is something that that definitely will have an impact, and that we need to take into account when we do our documentations for 2020, to double check how safe are we and how comfortable are we with all the people that have been in wrong places. If we then go to the next slide, I mean, as I said before, we have various centralized business models, and we also have the biggest part of our business is definitely something around 80% is on decentralized business model. On the centralized business model, I think Giuseppe will also talk a bit more about that, but what's the role of the principal? That was for us the key question. What's the role of the principal compared to the LRD? And we took the decision that, and also driven to the fact that we were not hit significantly like a lot of other companies, we said, yes, and it's an extreme situation, this COVID situation. Nobody could have thought about it, expected it. But we also said it's the principal has a certain functional profile. He is the entrepreneur in the whole organization. So if there are any issues popping up, we said we will keep it in a principle. We keep the LRDs at their targeted operating margin. And that's how we implemented it, also looking at, and we were waiting basically quite till a bit towards the end of the year to see what actually the actual outcome or the actual numbers are going to look like. Because as I said, it was very difficult to forecast what would happen during the year. So we took that kind of conservative approach, and that if we're going conservative, with the principal taking that entrepreneurial risk, and also in this situation. The point that I wanted to focus a bit more on is on the decentralized model. We have a mix. We have two models there for remunerating Switzerland. We are a Swiss-based company from origin. We have all our R&D as being funded out of Switzerland and managed out of Switzerland. We own all our all IP in Switzerland. We have a very strong presence here centrally with the corporate functions, with the zone management. So let's say the management teams of the regions who are responsible for the regions. And we have a remuneration model. We have a royalty model, and we used to have a fixed rate royalty model, percentage of sales. But over time now we have been implementing we call it a variable rate royalty model. It's not a true profit split, but it has quite a lot of elements on it. It's a co-entrepreneurship model, as we call it, where we are really looking, okay, if both parties are contributing a lot and their own elements to the activity and to the business and to the profit that we generate. And it's not easy to put a TNMM label, if we can call it like this, on one of the two parties. It's not just a provision of a IP and thereby a license, a fixed license rate is valid, because there's so much more provided out of Switzerland. Because for example, we also don't charge any management fees or anything. And linked to that, we said by implementing this model where it's also where the royalty payment done by the market is dependent on the profit that they make, and we have a few steps in that model, and then in the end there is a split of 60-40, 50-50, and that in those directions based on the value contribution of the two parties. And this is done by a process contribution analysis. We have been looking at it. And in this situation now with COVID, and I think it's a very good model that helped us in avoiding a lot of discussions, because we are both entrepreneurs. We both share the benefits if we're doing well, but also if there are market risks that were popping up last year, it's accounted for, because it has an impact on the total profit of the system profit that's earned in this country. And we actually had a model already in place where we can divide that and split that accordingly, the value accordingly to the value contributed by the two parties involved. So for us, this has been a very helpful model, I think. And it's, as I said, it's not a real profit split, but it's really linking to who's actually providing the value, adding to the value chain from both sides, but also really start looking at, it's not the full 6-step model from Isabel, but it's getting close. Looking at where's the value contributed and what are our key value drivers in the business, and then looking at who's contributing to that. And I think it's a good model, and this is also where we had a lot of discussions with authorities on this, as I was alluding to earlier, on how do we determine that split. And this is we have a lot of APAs ongoing, but it is still a point of discussion, I think, where we will have discussions, and everybody has its own view on that, what I noticed, and that will stay, I think, unless there is more guidance coming and more alignment on how to best treat these kind of things.
Thank you, Jan. Thank you. Giuseppe?
Yes. Here I am. So first of all, of course, thanks very much to Professors Danon, Chand and Maisto to invite me to join this prestigious panel. I'm honored to take part in this. I already had the occasion to interact with Isabel in my past, and Jean-Paul, and of course Gabriella, even when she was the head of the APA office for the Italian tax authorities. So I am in charge to briefly talk to you about the COVID-19 impact on transfer pricing for my industry, which is the luxury fashion, which is basically luxury, and then yes, also fashion. But one thing I deeply believe is that luxury is the industry, and then we have a sub-industry called luxury fashion, because for sure, my P&L is more similar to the one of Ferrari automobiles than to the one of Zara, just to make two very famous examples. But on the other side, most of my concerns, most of my comments, and most of the impacts that COVID-19 has been having in my industry are common to many retail businesses, and on the other side, to many personal good businesses. So I think that people involved in the audience in other industries may find interesting common areas with this respect. So please, next slide. So of course, the starting point is the value chain. I really stick to the kind of thinking that underlies the 6-step approach by Isabel that we are all quoting because we all like it very much, and we think that that is the core of transfer pricing nowadays. And what of course, I won't bore you to death with the full explanation of this value chain, which is of course my value chain of the luxury fashion. This is my view on the value chain. But what is it is important is that we have intangibles at the very core of our business. And I can say that unless there are some companies, some of my competitors that operate in a very weird way, luxury fashion is all a matter of centralized businesses, because everything is built around the brand and around the design. And that is the very core of it, because it is our leverage. It is our value adding pillar, these two-folded pillar of brand and design that, of course, now in times of circular economy and of sustainability being one of the mandates of many businesses, materials innovation, of course, is going to take a big part in the future developments. So this is our value chain. Intangibles play a very important part, and basically all of the key factors are controlled centrally, and this is underlying what I am going to say in the future. On the other side, we have the customer centricity, which is the first concept in the threefold summary sentence that I inserted underlying the luxury chain, customer centricity. So that is the core of our present and future issues with marketing intangibles, of course. Please, next slide. Whenever I talk about the impact of COVID-19, I think it's very important to differentiate the emergencies and the structural changes, which is basically the emergencies are the issues that we are tackling during the pandemic. So from a transfer pricing angle, it's the issues on the table in 2020 and just a little bit less, but in 2021 as well. And the structural changes is what we can observe are changing the field and possibly will eventually lead to changes in the transfer pricing model as an effect of the pandemic. So, of course, the pandemic, it has been said, it was a black swan. Nobody forecasted it. Nobody was expecting it. No three-year plan was baking in a pandemic, just like it happened with, I don't know, with, for example, with a world war or the creation of the internet. The stores, the massive stores lockdown that we experienced all around the world, many people have been trying to take examples in transfer pricing from the credit crunch crisis, and OECD guidelines on COVID-19 specifically addressed this. And I totally share OECD's point of view. This has nothing to do with COVID-19. The dynamics, even on the economics, are totally different. It's far more similar to what happened in World War II, because think about Wimbledon tennis tournament. The first time ever that it did not take place was 2020, and the last time was exactly during Second World War. In the month of April, Ferragamo, so 85% of its global network of stores totally closed, and most part of the residual 15% experiencing either limitation in the opening hours due to government regulations or a collapse in traffic of consumers. So that is really something like, even if of course shorter for a shorter time, but something like a global conflict, a global war. Then our merchandise very fastly ages, because our business is structured per collections. So this is a typo. Of course, it's not spring summer 21, but it's spring summer 20. What you can read in the slide. Basically, it was never sold. So that is an immediately aged stock excess that we never sold to final customers because our stores were closed. And then when you do operate a retail business, stores closed means zero cash in. So for the first time, we were experiencing issues with cash flows, which normally we do not have because we are a highly profitable industry. Normally, it says that if you don't have a double-digit EBIT margin, you cannot define yourself a luxury business. So it's 10% and sky's the limit. 35% EBIT margin is the rule of at least it used to be the rule for any luxury business. So human capital, operating issues, mindset changing. This happened to all of us working in any business. Limitations to travels. Jan-Paul was referring to that. Travel retail channel is a very important channel. So the stores, the luxury stores in the airport for the industry, but also 40% of the global consumption of luxury goods happens when people are traveling, either for work, regionally, intercontinental, etc., etc. So no travel in the world means that 40% of your turnover is at risk, more or less. On the other side, it is implied an e-commerce boom that just accelerated a change that was already happening, because traditionally e-commerce is not that fit to luxury consumers because they want to get the experience of a luxury store, of a very welcoming sales force, etc., etc. Social distancing, health and safety. So we experienced, as all the other industries, a new way of working. There was a revolution in customer experience as well, because our customers now are doing a lot of shopping, sitting on their sofas where a salesman using its WhatsApp or the newly developed interactive apps in order to see the products, and then they receive the products at home, they try them on, and then they return them to the store. So this is totally new. And then another impact, it's the uncertainty during and then about post-COVID. I am planning and control director as well. I was running continuous forecast of sales, of cost, of everything. It was like 5 times the times that I used to run that kind of simulations in an average year. What about the long-term planning? Because also, I mean, if we're going to keep the smart working as part of our working routine, then maybe we won't forcibly shop in the same old stores downtown or in the malls close to the place where we work. Maybe we will shop more in shopping malls included in residential areas. So what about CapEx? What about long-term investment in our network? And the question, when will we be back as an industry to the sales levels of 2019 and to that kind of profitability? Then special measures, incentives, they have been all around the world. And for the first time, a very rich industry like ours was monitoring opportunities and seeking for opportunities, at least to remediate the cash flows issues that we were experiencing in the first time. Next slide, please. So I tried to do an exercise very similar to Jan Paul's one. I followed the same scheme: positive impact, negative impact, government aid, higher costs. And here's my industry perspective: positive impact, e-commerce, of course, then China, Taiwan, Korea, partially Japan. These are all countries whose luxury consumers used to travel a lot and used to spend a lot when traveling due to price differentials. The same pair of Ferragamo shoes bought in mainland China costs a lot more than the same pair of shoes bought in Rome or in Paris. Now, with travels suspended, of course, in these markets, consumers were spending more on the domestic market, and so this had a positive impact. And then rent relief. I used to say that actually our majority shareholders have become the landlords, because when you are the landlord of a building in a classic luxury street, you know, Canton Road in Hong Kong, or Avenue Montaigne in Paris, or Fifth Avenue in New York, etc., then you can ask for a rent increase very often, and you end up eating a lot of our profit. So a rent relief negotiated with landlords was having a positive impact on our accounts. Negative impact, of course, retail brick and mortar was highly affected, and travel retail channel. The rest of the world, because all the rest of the world was relying on Asian travelers the more and more. So of course, the lack of Asian travelers and the limitations to the local consumers implied a collapse in demand. Then, of course, all the countries where we have a fixed rent model, mainly Europe and the United States. Of course, government aids were helping, and we tried to profit from them: delay payments, financial support, tax reliefs, tax credits, etc. And then the higher costs caused by the protection of employees, customers, the increase in digital investments, the acceleration of digital investments, remote selling, customer care, far more complex, far more costly than in the recent past. And then the cash flow crisis along the whole supply chain. Our suppliers were experiencing a cash flow crisis and lockdowns, and as well our retail distributors. Next slide, please. And I'll be very fast on that. So we can jump this, because this was just a focus on emergencies and new topics, specifically talking about finance. But we can jump to the next slide, please, which is what is going to happen after the COVID-19. Lower volumes and higher cost of doing business, which is going to stay because we need the digital channel very strong. We need to make remote sales. We need to make a lot of digital advertising and communication, etc. Will lead to lower gross profit, so in absolute terms, and lower gross margin in percentage terms. This will eventually lead to a new TP model, maybe, or just different margins. For sure, in a profit split method context, for example, but in any transfer pricing method, the cake is smaller, the profit is smaller, so we have to allocate a smaller cake. this is, of course, more difficult. So the remediations, of course, the easy ride was retail prices increase, our consumers are not that price sensitive, so I am head of pricing as well, I raised the prices. And many competitors did, and those are some examples. Cost cut is a quick win, but some costs are just fixed, and you cannot cut them unless you renegotiate main terms and conditions of relationships with third parties, be them landlords of our stores or other suppliers. A risky business is the investments cut or the retail network downsides. You do it to protect the EBIT margin in the short term, but in the long term may be costly. Of course, scavagenting, public aid tax incentives, already mentioned that, and then lifelong planning, a business model transformation, and talking about transfer pricing, APA's renegotiation. Last slide, last minute that I have of time. So here we are, emergencies and new topics. During COVID-19, emergencies. Shall we share the pain? Shall we share the loss between limited risk distributors and the principal? I mean, market risk it is a risk, however limited, but it is a risk. And when the demand collapses for a mix of government regulations and effect of the pandemic on people's lives, then some market risk effect should impact the profitability of a limited risk distributor. Then again, 2020 TNMM, we have limited risk distributors in all the world. What margin do you apply to year-end adjustments while we rely on comparable searches that refer to a totally different economic context? We experience a drop in sales, but the majority of our costs are fixed. So we have to deal with this on the transfer pricing side, 2020 and partially 2021. Also, one collection never sold, it means stock excess. It means we have to clear that stock. Even we destroy it, or we sell it on sale, or we sell it to wholesale customers at a discount. This will affect the gross profit overall. And then what shall we do with the comparability analysis? Because the OECD guidelines was totally no help, zero help in doing this. There was just some general statements leading nowhere, no business practitioner. So during COVID-19, the answer for transfer pricing is a huge, enormous question mark that possibly will be solved in just and only in case we are allowed and entitled to make adjustments during 2021 when reliable data from comparables are available. Post-COVID-19, big question mark. When we'll be back to 2019 sales volumes? There's a direct impact on all the accounts, on all the profitability, and eventually on the cake of profit that we should share. Maybe limited risk distributors in the future should be entitled to a higher margin, because now we have a clearer idea that market risk counts. Market risk is a risk, and maybe we have been underestimating it in the last years. APA's renegotiations, of course, where also negotiations currently happening. This is low. This is very, very slow. So we need to fasten that process if this is going to be a remediation and a way to solve the problems, and not to keep the problems on the table for the next 3 years because we will be busy negotiating. Talking about the intangibles, brand creativity is still the main leverage that we have to recover. So that those should be and must stay at the center of our value creation analysis whenever funding a TP analysis for the industry. And possibly the business model is going to be even more centralized, because if I have a higher cost of business and my marginality is still good when I sell at full price a pair of shoes, maybe in order to allow to compensate the lower profitability led by other factors, I should produce less stock. So I should manage stock in a more centralized way. This is just an example. So I see the industry going towards a business model more centralized, also because the customer is the more and more global. So there are the differences between a Chinese consumer and a European consumer and a Brazilian consumer are lowering themselves on a social basis, and also thanks to the globalization. So I need more global strategies, so I need less strong management on the regional side. So is DEMPE still valid in that context? Yes, in my opinion, but only to the extent that DEMPE is a building block of the 6-step approach analysis that Isabel so wonderfully explained in the first part of this panel. Thank you.
Isabel, would you comment?
I think that would be a nice way to end, Gabriela, with this flattering comment. But one thing on the APAs, that's very important. And there were some questions also in earlier panels. How fast can it go? And I would like to make the bridge to what Professor Maisto was saying at the first panel on hard to value intangibles and the OECD guidance on that. I think we should all think very carefully now about massively sending in responses to OECD for this call for input that they just launched. So they have published the country profiles, as we all know. There was a communication mid-December, and now there is a call for interest to discuss that further and to provide input. And what I experience is that, and this is not a criticism towards countries or APA commissions, because they can only do what is in their power to do. But if you have to ask for an APA covering 3 or 5 years, and you have this commensurate with income standard to deal with, and statutes of limitations and critical assumptions, it's almost impossible for APA commissioners to tango on this and to provide certainty, even if they wish. So I think taxpayers definitely have an interest in submitting those comments, but I think this equally applies to countries and APA commissioners in particular. So I wanted to make that plea to end with, Gabriela.
Yes, I agree with your view, and I consider also that if we consider how complicated is becoming this the world in which we have to work in terms of multinational enterprises, tax authorities, and practitioners, probably all actors try to introduce a simple way to solve a lot of problems. Seems to me that, considering what we said during this panel, that there are some ideas related to one methodology that try to cover the profit allocation, simplify the approach in order to be possible to apply correctly this new model, and the solution seems to be a solution between a profit split and a new digital approach provided by the OECD in the recent blueprint. In any case, there are a lot of problems. If I have to imagine a future for this methodology and a role of tax authorities in assessing the availability of data and information and the possibility to assess the way in which the taxpayer apply this methodology, probably the traditional methodology used by the tax authorities are not useful, consider this goal. And in any case, consider also some questions that arise from the floor related to the complexity of the characteristic of the profit split, the new pattern that the OECD tried to do. Probably there are few principles that we have to maintain in our reasoning. The simplicity, the certainty, and the possibility to try to allocate in a right way the profit all around the world. This is valid for the multinational enterprises. And we discuss about the centralized model and the decentralized model. And probably we have to imagine also an evolution of the tool that the tax authority use. The APA are a valid instrument, but as Isabel said, probably it's quite difficult to fix an imagine of a multinational operation and activity in an agreement that remain in force for 5 years. Well, I think that we have concluded our time, and I would like to thank all panelists and attendees. And if not other comments, we can leave the floor to the next panel.
Thank you, Gabriela. What we are going to do right now is we will take a break and we'll be back at around 3:15 to start the next session. And the next session deals with intra-group financing transactions, which is headed by Professor Maisto himself. So we'll be back at 3:15, and I would like to thank all the panelists once again, Giuseppe, Gabriela, Jean-Paul, and Isabel for their wonderful interventions. I really enjoyed the session, and it was really interesting, especially hearing the business viewpoints on COVID-19 and how they are dealing with it. And what I gathered is that there's no one solution which fits everyone. So you just have to, be proactive and probably have a discussion with the tax administration upfront and tell them, okay, this is a global issue, and just let's be realistic on some things. And if they are accommodating in nature, they'll accommodate you. If they don't, they will fight. And then you get into a big discussion. So thank you once again.